FM with Sir Evans. In today's tutorial session, we would solve selected questions on cost of redeemable, irredeemable, and convertible debts, which is in the second part of the second competency, the syllabus of ICA paper 2.4, financial management. Let's get started. So we'll start off with the cost of irredeemable debt. So from the main session, we realized that market value is equal to the annual interest payable divided by the pre-tax cost of debt. But where you are also considering the post-tax cost of debt, it's going to be market value is equal to the interest payable multiplied by 1 minus a t all over the post-tax cost of debt. So when you do change of subject, you'll be able to find the appropriate variables. But you need to note that calculations are usually performed on a nominal amount of 100 or 1,000. So we'll take our first example. The coupon rate of interest on a company's irredeemable bonds, that's perpetual bonds, is 6%. And the market value of the bond is 103.60. The tax rate is 25%. So we are supposed to find the cost of debt. So we'll start off with the pre-tax cost of debt. So the market value is 103.60, which means the nominal amount is 100. Now the interest payable is going to be 6% times that 100 to give us 6. Our market value being given is 103.6. Therefore, our pre-tax cost of debt is going to be the I divided by 6 over 103.6 to give us a pre-tax cost of debt of 5.8%. Now, we'll go with the post-tax cost of debt. So same variables, I being 6, MV being 103.6, but now we are introducing a T being the tax component, that's 25%. As I mentioned, our I then will be applied with the tax. That will be I multiplied by 1 minus T. So 1 minus 0.25. So our 6 will multiply 1 minus 0.25 divided by the MV to give us a post-tax cost of debt of 4.3%. Now we'll look at the cost of redeemable fixed rate debt. This is different from the ordinary redeemable debt. So for fixed rate debt, the value of the redeemable debt is calculated as the present value of the future cash flows, right? So from the lender's position, it is discounted with the pre-tax cost of debt, and then for the company's position, it's discounted at the post-tax cost of debt. So you should take note of that. So this is the example. A company has issued 7% loan stock. Annual interest has just been paid. Bond will be redeemed at par after 4 years. The lender's required rate of return is 8.14%. Find the market value of the loan stock. So we are going to use the pre-tax cost of debt. However, there's even been no tax component given to us because we are looking at it from the lender's point of view. So as I mentioned, is the present value of the future cash flows. So we'll come up with our table showing the year, the cash flow, the discount factor. Now the required rate of return is 18.14%. That will be our discount factor. And you know, in finding the discount factor, the formula is 1 over 1 plus r raised to the power n. So based on the year you are dealing with, then you show the n to be a 0, 1, 2, 3, or 4. Then you also show the AR, which is the 8.14%. So let's go with the first year. So for the first year, our interest is 7. Now it's 7 because 7% of the nominal amount, 7% of the 100 to give us 7 being our interest. Our discount factor is 0.925, giving us a PV of 6.48. Second year, 0.855 being the new discount factor for the second year. Third year, fourth year, and now since it's a redeemable fixed rate debt, in the fourth year it's going to be redeemed, and it's going to be also redeemed at par, being redeemed at the 100. If it's redeemed at a premium above the 100, redeemed at a discount below the 100, but redeemed at par, it's going to be redeemed at exactly the 100. So our redemption amount in the fourth year is also going to be discounted, and we'll sum all our PVs, and the total PV, that's the NPV, will give us the market value of our redeemable fixed rate debt. Okay, so we move on to the cost of redeemable debt. So the cost of redeemable bonds is the redemption yield at which the bonds are currently trading in the bond market. So what that means is that they are looking for the rate of return that equates the present value of the future cash flows on the payable on the bond with the current market value of the bond. So it's the IRR of the various cash flows on the bond to maturity, assuming that even the current market price is also a cash flow. So we'll be applying the IRR, internal rate of return formula, which is our discount factor 2 plus our PV of the 2 over PV2 minus PV1 multiplied by discount factor 1 minus discount factor 2. Details of this is in the main session. That's the session 2B. Okay, so we'll take an example. The current market value of a company's 7% loan stock is 96.25. So in this situation, even the market value will be included in our discounting. And then the annual interest has just been paid. The bond will be redeemed at par after 4 years. The rate of taxation on company profit is 30%. So we should find the after-tax cost of the bond for the company. So we come up with our table, considering the presentation, because it's an IRR, we'll start off with a particular rate and then we'll presume another rate. So I've straight ahead shown the 6% and the 5% for presentation purposes. So our market value, as I mentioned, would also be included in our discounting. So you see the 96.25 shown there as a negative. Now you need to know that the direction of the cash flow may be a little different here. While some are coming as an inflow, others are going as a cash flow, as an outflow. However, this does not really matter. What you need to know is that the one direction has the market value and the tax benefit, and the other direction has the interest and the redemption. So where you show the market value as an inflow, then the interest plus the redemption must be an outflow, and vice versa. So in year 0, we have 96.25 being an outflow, discounted, and then in year 1, now our interest is going to be 7% of the nominal amount, being 7. But you see here, we have a tax component, and we are doing after tax. So our I will be I1 minus T. So I multiplied by 1 minus 30 being 7%, 7 being the interest, multiplied by 70%, giving us 4.9 Ghana cedis. Okay, so our second year still 4.9. We discount them both at the 6% and the 5%. Our third year follows suit, fourth year follows suit, and in our fifth year, the question mentioned that we are going to redeem it at par. So redeeming it at par, then we will have 100 being the redemption amount. And at the end of the day, we find the NPV to give us 0.07 for the first discount factor and 3.41 for the second discount factor. Now we insert this into the IRR formula. So I read this out some few minutes ago. So DF2 being the discount factor 2 plus PV2 over PV2 minus PV1 multiplied by DF1 minus DF2. So our DF2 being our discount factor 2 with the 5%. Our PV from discount factor 2 is 3.41 as we can see. And we have PV1 being 0.07. So we insert into the formula and we get an IRR of 6%. Our IRR becomes 6%. We move to the next question, which is the cost of convertible debt. So for convertible debt, we look for the higher of the cost of the bond as a straight bond that will be redeemed at maturity, and the IRR of the relevant cash flows, assuming that the conversion of the bond into equity will take place in the future. So we have two instances here because it's convertible. Either we go straight ahead and we redeem our bond on maturity. In that scenario, we do not convert, or we go ahead and convert upon maturity. So the higher of the two, we look for the present value of both instances. The current, the cost of bond when it's a straight bond going to be redeemed at maturity, and the IRR when we are going to convert it, we find is also a cost of bond, and then we look for the higher of the two to be the cost of the convertible bond. So we'll take an example. The current market value of a company's 7% convertible debenture is 108.7. So just at this point, we need to know that the nominal amount is 100. Our interest is going to be 7% of that 100, giving us 7. Now the annual interest has just been paid. The debenture will be convertible into equity share in 3 years' time at the rate of 40 shares per debenture. This is when we are going to convert. We are going to convert it into 40 shares per debenture in 3 years' time. And the current ordinary share price is 3.20. And the rate of taxation on the company profit is 30%. So with the tax coming in and looking at it from the perspective of the company, then we are looking at the post-tax, which means our 7 is going to be impacted by this tax rate, giving us I, which is 7, multiplied by 1 minus 30, which is 70. So 7 times 70%. Okay, so let's look at it. We come up with our table. In this instance, too, we are using 10% and 9% for the IRR. Kindly note that this scenario, this solution looks at we calculating it if we are going to convert, because as you are aware, we looked at when we are going to redeem it. So now we are looking at if we are going to convert. So we look at so in this instance, we mentioned that we are going to assume that the conversion is going to take place and the market value is also going to be considered as a cash flow. And with the previous scenario we looked at, we said that if the market value of it is going to be treated as an outflow, then the interest and redemption is going to be treated as an inflow and vice versa. So this position here is looking at the market value as an outflow and the other ones as an inflow. So the market value is 108.7, and then we found the discounting for the 10% and 9%. Now for year 1 to 3, we know that the interest is going to be constant. So here we are introducing what we call annuity, which we'll look at subsequently. But let me just give you a heads up. So the annuity considers constant frequent payments or constant frequent cash flows over a period of time. So this discounting factor of 2.487 is an annuity discounting factor, present value annuity factor, which we look at subsequently. So 4.9, other than that, you could do year 1, 4.9, you find the discount factor. Year 2, 4.9, find the discount factor. Year 3, 4.9, find the discount factor. So this has been bulked to give us a discount factor of 2.487 using 10% and 2.531 using 9%. The third year is if we are going to convert it into shares. So we said the value of shares on the conversion is going to be 40 shares per debenture, 40 shares per debenture, and the ordinary share price is 3.20. So 40 times the 3.2, giving us 120. It's been our conversion inflow, And we also discount that at the year 3, using the year 3 discounting factor for 10% and 9%. So when you finish, you sum all of it and you apply the IRR formula, and that will give us 9.9%. So let's just walk through that application in the IRR formula. So IRR is equal to DF2 discount factor, so which is the 9%, plus the present value, net present value for the 9% is 2.52. So 2.52 divided by 2.52 minus 0.38. Minus 0.38 is the present value for discount factor 1. So it becomes 2.52 minus 0.38, which is 2.52 plus 0.38. We multiply it by the 10, which is discount factor 1, minus 9, which is discount factor 2. So that will give us 9.9%. So now we are saying that the cost of convertible as a straight bond will obviously be less than the 9.9% when you apply. Since the market value is above par, the market value is 108.7. So when you do that, you get that, you will find that the cost of the convertible, if it were a straight bond, is going to be less than this 9.9%. Therefore, the market therefore expects the bond to be converted into equity, and the after-tax cost is 9.9%. So we'll take our last example being a cost of convertible debt. So the value of the convertible cost of convertible debt is going to be the cash flows, where we first consider the market value to also be a cash flow, and at the end of the whole period, when it is converted, then how much is going to be, right? So we mentioned that we consider that convertible position with if it were a straight bond, and we look for the higher of the two. So this is an example. A company has issued 4% convertible bonds that can be converted into shares in 2 years' time at a rate of 25 shares for every 100 cedi of bonds. So it is expected that the share price in 2 years' time will be 4.25. If the bonds are not converted, they will be redeemed at par after 4 years. The yield required by investors in this convertible is 6%. What is the value of the convertible bond? So in this position, we'll first look at the various interests we are going to earn. So it's a 4% convertible bond. So interest of 4 being discounted at the 6, interest of 4 being discounted at the 6%. And then at the last second year, when we are going to convert it, we have the share value to be 25 times 4.25. So that will then give us a market value of 101.89. So that will be for the position if we are going to convert. So the other position is if we are going to redeem it. So the interest for 0.94 for the second year, for the third year, for the fourth year, and the fourth year we are going to redeem it at par. So it's going to be the 100 being the redemption plus the interest of 4. That will also give us a market value of 93.06. So we realize that comparing these two, the higher is 101.89. And then the value of the convertible bond is therefore going to be 101.89. The expectation that the bonds will be converted into shares when the opportunity arises. So these are some of the questions that we touched on in session 2B, and I hope this tutorial session was detailed enough to assist your understanding. So I'd like to thank you very much for staying with me to the end. Kindly follow the link below to join the Telegram channel, which is created for the paper, so you have access to the slides and also have discussions, ask questions on this discussion as well. So thank you once again, and I'll see you in the next session.